Hi, I'm Anna, and welcome to my channel. If you're a business owner, founder, or professional service provider who's ever thought, I'm making money, so why does cash feel tight? You're in the right place. I've spent the last 25 years or so in corporate America as an accountant and financial analyst. I usually work behind the scenes on strategy, cash flow, and decision making for growing organizations. Today, I work as a fractional CFO, helping business owners get clarity around their numbers without drowning in spreadsheets or accounting jargon. So, on this channel, we'll talk about the things that actually move the needle: cash flow, profitability, financial blind spots, and how to make smarter decisions with the numbers you already have. Practical, real world stuff. So to kick things off, I want to share a cash flow management webinar that I recorded about 2 weeks ago. It's designed specifically for professional firms, private practices, anyone actually dealing with uneven cash flow, delayed payments, or that constant feast or famine cycle. So enjoy this cash flow webinar, and thanks for being here. Let's get into it. Everyone, and thank you for joining. I'm really looking forward to today's presentation where we will discuss cash flow management. I'll be providing quick, easy processes that you can implement today to start to see a positive change in your cash flow. I will also discuss intermediate and more robust practices that can further improve your organization's liquidity. I will have a free gift or two at the end of this short 40-minute webinar, so stay tuned until the end. I'll begin by introducing myself. I am what you might call a reformed corporate accountant. For the last 25 years or so, I've built my career inside corporate finance departments, learning all of the ins and outs of strategy, cash flow, and the numbers that drive decision making. And the truth is, I've loved it. I have had a great career playing with numbers and getting a strong sense of satisfaction from the work that I do. However, when the pandemic hit, something changed. I saw many small businesses struggle and in some cases close their doors. It was heartbreaking. It made me realize that small businesses need the financial guidance so much more, significantly more than the Fortune 500 private equity-backed giants. Small businesses are the ones that should benefit from financial guidance to build resilience and to have the foresight to successfully navigate uncertainty. So now I do just that. I am committed to helping small business owners like yourself protect and strengthen your cash flow. So I thought we would discuss what cash flow is, what it's not, and why it matters. And as I promised, we will discuss basic, intermediate, and more advanced processes to help you improve your cash flow. I'm really excited to show you how you will be able to predict your cash position based on the decisions that you make today. So let's get started with the definition. So by definition, cash flow is the net amount of money flowing in and out of your business during a specific period of time via your operating, investing, and financing activities. Your cash flow should cover the cost of your operations like payroll, paying your vendors and suppliers, and it includes paying yourself and investing in your growth. So now let's discuss what cash flow is not. So cash flow does not equal profit, and profit does not equal cash. Many are confused by this. I personally have been asked by CEOs why their sales and their revenue is not reflected in the bank balance. And the truth is, you can show a profit, but still run out of cash if clients pay late or if your expenses hit early. It's best explained by looking at this example. So in this income statement, profit and loss, we have revenue. And when you deduct the expenses, you're left with a $47,000 profit. However, if we take a closer look specifically at the revenue, you've done the work and you've invoiced for that work and service, And that's what's reflected in this line here. However, you may not have been paid yet. And despite not yet having been paid, you've issued cash payments related to generating this month's revenue, primarily payroll. Additionally, any cash payments to the bank for loans, credit cards, or to the IRS for estimated tax payments, these are not reflected in the profit and loss statement. So essentially, profit ignores the cash that you have yet to collect and cash payments to lenders, IRS, or capital expenditures. Cash is the lifeblood. It's the oxygen of your business. It is essential to your operations, to your organization's growth. Now, why does this matter? So regardless of the amount of money that you make, that you receive, if it's less than what you're spending, then you're essentially eroding your cash reserves. If this is left unchecked, this will negatively impact the ability to pay your bills, to operate your business. However, when you master cash flow management and you apply discipline to how money moves in and out, you do more than just keep the lights on. You grow the value of your company. And when every smart spending decision ties back to building enterprise value, it has a compounding effect. Reinvesting in growth isn't just good business practice. It's the fastest path to creating lasting wealth for yourself. Now, some basics: invoicing, collections, and expenses. One of the most important ways to improve cash flow is to invoice immediately. Invoice immediately after a project or a milestone, or immediately upon completion. This gets the clock ticking. It sounds like a no-brainer, but you'd be surprised how many businesses do not have this process dialed in, and how much time and leadership effort is spent on fire drill, reactive approach to invoicing fails. Automation can help, but before you do this, I'm going to recommend that you start by mapping out the steps involved in getting an invoice into the client's hands. How many people are involved? Are there precursors or prerequisites? And if so, what are they? Do they cause bottlenecks? Once completed, how long does it take to actually get the invoice into the client's hands? Studying and streamlining the billing process will speed up the time to get the invoice into the client's hands and reduce the cost of invoicing customers. Both will actually improve your cash flow. Accounting software can automate recurring invoices and distribute electronically via email. Offer simple solutions to pay. Think about your own experiences when paying for something. If it's online with a simple click of a button, Apple Pay, for example, it's pain-free. If you make paying invoices for your clients easy, there's a higher likelihood that they're going to pay. Again, many accounting software today offer a Pay Now button. If you focus on getting your money faster, you'll be well on your way to improving your cash flow. So once you've automated your invoicing and you've tightened up the timing, it's time to turn your attention to collections. The goal here is simple: shorten the gap between sending an invoice and getting paid. Every day you're doing the work that a client hasn't paid for, you're essentially funding their business, interest-free. That's cash flow sitting on someone else's balance sheet instead of yours. Assign a collections owner. This could be someone on your team that will be accountable for the process from start to finish. One thing that works really well is having them call the client about 5 days before the invoice is due. Keep the tone positive, of course. You can frame it as a client service touch point. Confirm that the invoice has been received, ask if everything looks correct, and check how things are going with the service or the work that you've provided. It's a great way to catch small issues before they turn into payment delays. However, make sure to choose your collection owner wisely. It should not be someone that's pulled in multiple directions like a receptionist, juggling calls and front desk responsibilities. Instead, Pick someone with stake in the game, maybe a salesperson who earns commission or an account manager who owns the relationship. That way, they're incentivized to follow through and they'll uncover valuable feedback from the client. And yes, you'll occasionally hear the classic, the check's in the mail. So your collections person should be ready for that. Have them ask for key details like the check number, the amount, the mailing date, and offer to process it via e-check if possible. If it's a partial payment, find out why and when the balance will come through. Of course, always keep billing details and copies of invoices handy so they can resend them on the spot. That proactive phone call 5 days out typically prevents most of these headaches. Finally, encourage your collections owner to really listen during these conversations. Payment delays often hint at service issues or communication gaps. Addressing those right away not only accelerates the payment, it strengthens your client relationship and it reinforces your commitment to quality service. Review the accounts receivable report. Executives can gain significant insights into not only the cash flow of your business, but also understand client payment trends while ensuring your team's accountability. If your team members know that you are reviewing this report periodically and they expect follow-up questions, collections will remain at the top of their to-do list. Collections is about consistency, so we need to be firm, focused, and friendly. Friendliness limits the stress and creates a more comfortable experience. The idea here is to make the client comfortable and ultimately eager to help resolve any late payments. Now let's talk about controlling cash outflows. One of the simplest levers to pull is timing your payments to vendors and suppliers. Managing payment timing can make a real difference in your cash flow, especially over the long run. I've worked with many dedicated accountants who take pride in staying on top of their day-to-day work. Their instinct is to clear everything off of their to-do list. They pay everything that's due right away and they move on. But from a cash management perspective, that discipline can actually work against you. The rule of thumb is simple. Pay bills when they're due, not before. Use ACH payments to your advantage. You can schedule payments 2 days before the due date listed on the invoice. Tools like Bill.com make this easy to automate and to track. The exception, of course, is when early payment discounts are available. If a vendor is offering you a discount for paying, let's say, 10 days early, then of course, take it. That's an excellent return on cash if you can afford to do so. Now let's shift to payroll for a moment. If your business currently runs payroll on a bi-weekly schedule, you have probably noticed that about twice a year, you end up issuing a third payroll check in one single month. That extra run can strain cash flow, particularly for businesses without a firm budgeting process. Switching to bi-monthly payroll gives you more predictable cash demands each month without changing what your employees earn. Finally, one of the most powerful and often overlooked ways to protect cash is to review your expenses line by line. I can't emphasize this enough. In almost every organization that I've worked with, except for one because it was a startup, we've uncovered waste or unnecessary spending hiding in plain sight. So make sure to block some time periodically or assign a trusted team member to audit your expenses alongside your accounting manager. The goal is to ask, does this expense add value? Does it drive sales or retention? Pay special attention to overhead. Common culprits include errors in medical insurance invoices. Sometimes businesses keep paying for employees who have left months ago. Also, review subscriptions carefully. Some might have been tied to a short-term project or a single client. Check software licenses too. Are you paying for users who no longer need access? These reviews don't just cut costs. They sharpen your visibility into how every dollar supports your strategy. Now let's look at what I'm calling intermediate habits to build discipline around cash flow. The first is to look at accounts receivable key performance indicators. We'll look at job service type profitability and AR review. After all, you can't manage what you don't measure. Days sales outstanding. So it is the average number of days it takes for you to collect payments after invoicing. Obviously, we want to strive for the shortest amount of time it takes to collect payment. In this example, let's say that we are calculating the company's DSO for the first quarter of the year, January through March. This company had the following values. There were $80,000 in total net credit sales from January to March, and $45,000 in total accounts receivable for that same time period. So what we see here is that it takes this business on average 51 days to collect receivables. In general, a DSO value below 45 days is considered good. Anything below 30 is considered excellent. Now keep in mind that your DSO depends on the size, the region, and the practice area of your firm. As an example, professional services firms in general target 30 to 45 days. Law firms are typically 45 to 60, but again, it depends on your practice area, the size of your firm, etc. For example, engineering or architectural firms might see 50 plus days if retainers are not there and progress billing is not in place. Finally, knowing how long it takes your company on average to receive customer payments will help you get a grasp of the status of your cash flow. Plus, not only can DSO tell you more about the effectiveness of your collections team, but it can also give you insight into customer creditworthiness and satisfaction. So moving on to job costing, most professional services firms have some form of job costing, but few use it to its full potential. The real value lies in ensuring that you're paid for all of the work and impact that you deliver. Job costing helps you identify which types of projects truly drive profit. So for example, Job A generates $1 million in revenue and costs $900,000 to complete, a $100,000 profit. Job B, meanwhile, brings in $500,000 with $400,000 in costs. While both show the same dollar profit, Job B actually has a higher profit margin and is therefore more attractive from a return perspective. By accurately tracking the cost of delivering each service, you can set pricing that supports your target margins and strengthens cash flow. This insight empowers you to focus on the most profitable clients and services and to move away from those that consistently dilute results. If you have an accounts receivable report each month, you can take the analysis a step further to identify trends and improvement opportunities. Here's what to look for. In your aging buckets, review how much of your receivables fall into each category. Your current 1 to 30 days should be about 60 to 70% of total receivables. Your 31 to 60 days should be 15 to 20%. 61 to 90 days should be 5 to 10%. And nothing over 5% should be in the over 90 days. This is considered high risk and potentially uncollectible. Most accounting systems list clients alphabetically by default. You can resort the report by largest outstanding balances or oldest invoices so you can focus on problem accounts first. Reviewing this report monthly gives you visibility into both the performance of your collections process and the team managing it. You'll be able to monitor progress over time and address any negative trends before they escalate. Moving on to more advanced cash flow practices, my absolute favorite is the cash flow forecasting and planning. This is an example of a cash flow forecast for a 12-month period for a fictitious company. For the purposes of this example, let's assume that this is for 2026. I think I'll give you a quick lay of the land first before getting into some case use scenarios so that you can see how you will use this in your organization. So this cash flow forecast is comprised of the three categories: The first being operating activities. You'll recognize this as cash inflows and outflows from operations. It looks very similar to your profit and loss, your income statement. It also reflects cash inflows and outflows from your investing activities. This organization chose to invest in software and computer equipment. And finally, the third component is financing activities. If this organization planned on obtaining a loan, the cash from the approved bank loan would be reflected here. In this case, the organization is paying down a loan acquired in a prior period, as well as credit card payments. And you can also see that this organization pays owners a distribution on a quarterly basis. The bottom rows reflect the actual cash position. You'll see that we begin the period with our balance, $350,000 from the December 31st reconciled bank balance. We adjust the monthly changes to calculate our balance at the end of each period. This organization has a cash threshold of $300,000. The owners want to ensure that they can cover payroll. So anytime cash dips below $300,000, it's reflected here in red. Now, this is a dynamic forecast that includes client and employee information. Client revenue is allocated by month for the year, and similarly, the employees are also listed here. Both their annual salary as well as their benefits is allocated by monthly spend, as is the payroll tax expense. So now let's get into some use case scenarios. Let's say you're doing really well in the first 3 months of the year. Your actuals are coming in very close to what you had planned. However, you receive a phone call in March from one of your clients, Scientific Bio. They've suffered a significant reduction in revenue. And what that means for you is that a project that you had previously budgeted will now be reduced by half. So beginning in April, $34,000 will now be reduced to about $17,000. Once these adjustments have been made to the forecast, you can see what the impact is. The cash at the end of the period is negatively affected. The owners at this point agree to launch a business development campaign with the understanding that it will take some time before new clients are secured and even more time before they see cash inflows. Therefore, in addition to launching a new business development campaign, the owners decide to reduce their distributions by 50%. And as you can see, this definitely improves the cash position for year end. So they now move forward confidently, performing very, very close to plan. However, in July, they learned that they've lost a client and they'll no longer receive revenue beginning in August. We can also make those adjustments. But it's not all bad news, since the business development efforts from our first scenario back in March are starting to bear fruit, and we can also adjust for that. Additionally, their last hire, an administrative assistant, despite the training and the counseling, is just simply not working out. So based on these circumstances, a sad but necessary decision is made to terminate this employee. Once these changes have been made to the model, we can see that we end the year in a positive cash flow. So as you can see, this is a very powerful tool. A dynamic cash flow forecast gives leadership a live, forward-looking view of cash so that decisions are based on where the business is heading, not just where it has been. It turns cash planning into an ongoing management tool rather than a once-a-year exercise. This can be updated regularly with actual results and new assumptions, improving accuracy and making it easier to spot upcoming cash gaps or surpluses early. This advanced visibility supports better decisions on hiring, capital investments, debt, and distributions. Thank you again for your time today, and I look forward to speaking with you soon.